Aloha, everybody, and welcome to Cash is Trash, Cash Flow is King. Such a catchy title. We will be talking about how you can unlock cash flow as a private lender. We are Rise Capital Investments and are here to help you kind of understand a little bit about how real estate investing works.
All right, I'll get started. Feel free to unmute yourself, raise your hand, ask some questions as we go along, because I want to make sure that what we are covering is an appropriate level for the listeners that are actually in the call. Start out kind of high level overview, but if this is something that you know a little bit more about, like feel free to pipe up so that we can make sure that we understand where you're coming from. Kind of tailor it how deep you want to go. Should last about 45 minutes. And like I said, feel free to jump in and ask questions. So the first thing you have to kind of ask yourself is, why is cash trash? We hear people say that a lot, but in this case, if you're looking for kind of reliable income, which is what we're all looking for, it's one thing to be a paper millionaire. You have a lot of equity, you have a high net worth, but maybe your projects are going up in value and they're not. It would be similar to if you are living in your personal single family home and you get on Zillow and you're looking at the value, and the value of your house keeps going up and up and up and up, but you can't eat that. You can't take that equity to the grocery store. You can't use that to make your car payment. You can't use that to go on vacation. You have to actually liquidate the asset in order to get at any of that value. And so it makes you look like you have a high net worth on paper, but you're not really feeling it because you can't actually spend any of it. And so cash is unproductive. If you're holding actual cash, that's in some ways better than equity, but if you spend that cash, it goes away. So if you imagine that you have your cash stashed under a mattress or something, and every time you need to buy something, you go and you pull that out and you go and spend it. There's no cash machine or money tree under your mattress that's going to be making more money for you. So trying to figure out how you're going to hold your cash and what you're going to invest your cash in that will pay you reliable cash flow is really what this is all about. So the problem with holding on to cash, and I know that a lot of us are in the same situation, and most of our investors come to us after they've had some sort of a windfall, like they sold a house, they sold a business, maybe they got some sort of a layoff, severance, a settlement, a judgment, those kinds of things where you're holding more cash than you're used to holding, and you just want to make sure that you take care of it. And so the initial reaction is like, I don't know what to do. I've never had this much money in my life, and I just want to make sure I'm being responsible. So we know we need to invest it because we don't know what we're doing. We tend to kind of just hide it in the mattress, right? And because not only are you having to take that out and spend it on things that you need to spend it on, and it's punished, inflation is also eroding it. We know right now that the effect of inflation has been double digits. And so if your cash is not going up in value, then you are losing that amount of value in your cash every single year that you let it sit in a savings account or a money market or under your mattress or in a jar in the backyard. Inflation is wearing that away. And I think that most people are aware of that, but they're not really sure what to do about it. And so it gets even worse than that, though. The opportunity cost of holding on to that cash and not doing something with it, you're losing out on the compounding effects of reinvesting your proceeds. So the ideal would be to live off a portion of what you're investing in and then take the rest of that to go reinvest. And so if you're not doing that, you're missing out on a lot of opportunity to get that compounding. We all know that the longer you have it and reinvest it, the more money you get, and you kind of just skim off the top of that. So the other thing that we're seeing is with low interest rates. I know everybody's complaining about how interest rates have been so high lately because they've been going up. But I remember one of my first jobs when I was in high school, I was actually working for a local loan officer, a mortgage broker. And I would do cold calling to tell people that they should refinance their house because the rates were down to 7.25%, and people couldn't believe it. They're like, what? Yeah, sign me up. I want a consultation. And my parents refinanced their house probably 3 times during that period of lowering interest rates, because when I started, it was 9 and then 8 and then 7.75, 7.5. The interest rates that we're experiencing right now are still extremely low historically, and savers are penalized when interest rates are low because your bank account is maybe paying you 1 to 2%, and inflation is average of 3%, but lately it's been double digits. And so those low interest rates are actually harming you if you're holding on to too much cash. So the other issue is that you have all sorts of volatility in the economy and you're not really sure, like, where should I put it? What should I do? And so not staying on top of that and making sure your cash is working for you is going to come back and harm you later. And then again, we're back to the original lack of cash flow, where you can't eat equity. And if you spend your cash, it goes away. And so we're all looking for investments that are going to give us reliable cash flow, because we want to have that passive income lifestyle. Like, we want to have the opportunity, if we want to travel more, quit our job, or start a business, or work on a passion project. If you don't have cash flow, none of those things can really happen, because we all need to keep the lights on and we all need to eat. So that is why I try not to hold too much cash, and I try and invest it in things where that money will grow, and then I can live off some of the dividends or distributions from that money. So next slide. Any questions on that? Any personal stories to share of mattress money barriers? You'd be actually surprised how many people come to me and tell me that they've got $500,000 sitting in a savings account. It happens a lot because they've been saving up their bonuses or something. So I know that that it's something that a lot of people are dealing with, and it's a common issue. So we want to make. All right, cash flow is king. Cash is trash. Cash flow is king. This is where you have your cash invested and you are living off of the distributions of that. And then you are able to reinvest the original principal so that it keeps feeding you like a money tree, like a little ATM. So you get asset appreciation, because what you're investing in is usually something that's going up in value. Now, there are certain cases where that's not the case, but in real estate, it's typically going up in value. And we all know here we are powered by real estate. It generates passive income. So it's income coming in that you don't need to work for. It has liquidity because you're getting cash flow off of it, even though the original principal may be in an illiquid investment. Like, let's say you loan money, it's going to be illiquid during the term of that loan, but you're getting the liquidity from, because it's paying you every month or every quarter. So you're able to leverage better opportunities and really secure your financial future, because you're able to have more control over your monthly income. All come at it from like a lowering your expenses, but what if you could actually increase your income instead of just lowering your expenses? Just kind of thinking about lifestyle decisions along those opportunities. So we all know cash flow is better, and if we are hesitant of what to put our cash in, I think that being a private lender is one of the safest things that you can do to get above average returns that are going to compete with our current rate of inflation right now. All right, any questions on that before we move on to the next slide? All right, fire away.
You are on fire, Mrs. Paul. So let me just kind of jump back in, because we talked about cash flow, we talked about equity, and we want to make sure we're all on the same page here. You can obviously buy an asset in an equity position and still generate cash flow. You can value add properties. You can buy a property outright and get cash flow. I guess the scenario that we're looking at here, and the way we'd like to look at it, is we like to sort of diversify. It's sort of, I like to use the analogy that we're looking at it like the equities market or the stock market. Your typical portfolio will have a mix of stocks and bonds, right? You're going to sit down with your financial planner and he's going to say, what is your risk tolerance? And he's going to try and understand what your risk tolerance is. And then he's going to allocate whatever capital you have based off of your risk tolerance, based off your age, based off your risk tolerance. And then obviously, typically, I wouldn't say obviously, but typically the older someone is in their journey for accumulating cash, accumulating wealth, they're going to put them in more of a safer asset versus a much more riskier asset. And again, this is just I'm using it in comparison to the equities market. So we sort of like to look at it the same. We like to look at it as far as diversifying between both larger equity deals. I see we had a lot of investors pop in that we know. So like RV parks or different multifamily assets, like those are equity deals. And you're going to typically, if you're going to invest in those, you're going to be in an equity position. Those are typically going to have much higher upsides. But they also ebb and flow. All real estate, they ebb and flow with, there's cyclical cycles in there. And typically in a higher interest rate environment as we are now, it does start to eat away a bit at cash flow. Now, we like, again, going back to that diversification side of things, we diversifying into the debt side of it, which is basically fixed. You negotiate and agree on a fixed price predetermined in the beginning of the acquisition of the property, and that stays fixed throughout the duration of whatever terms it was structured in whatever note that you placed on that particular asset. So it's safer in there's a few things that it's safer in. One, you're not going to have as much impact from interest rates and the economy because again, it's fixed. You agreed on exactly what the amount of payment that you would get each month or each quarter, however it was negotiated uh, up front. So there's nothing that can really impact that going forward. And the other part is you're still looking at an asset, and this is real estate, so we're still acquiring assets. It's just where do we sit in the risk level, the lien profile, or the capital stack? Like where are we? And if we had to exit out of that property, if something happened and we had to exit out of that property, in what position would we be paid? And on the debt side of it, you're going to typically be paid first. It depends on where you're at in that lien position or the capital stack, but normally it's going to be first or second. And then after that, you're going to have payout between the different, depending on where you're at on the equity side. So you're looking at it. So we're looking at the cash that we have, and it's just kind of reiterating what Emma was saying earlier. Like if you have cash, it's definitely not good to have it just sitting there. And I'm gonna be honest, it still depends. It still depends because there's cycles out there. There's both real estate cycles as well as cycles in the equity market. If you're at the trough of a cycle, I'll be honest, you want as much cash as you can possibly have. So you just need to be able to understand where we're at in that cycle. And it's harder to predict the cycles and to know exactly where you're at in the cycle. So and you probably hear it over and over again. Never try to time the market. It's always good to continuously invest. So you're kind of looking and trying to analyze that. Now we're saying if you're sitting on cash, it still makes more sense to have it invested in some kind of asset where maybe you're not taking on as much risk and maybe you have a little bit more liquidity than in an equity deal. Your typical equity deals, you're looking at a little bit longer time horizon than you would on a debt deal. And that even depends because you can invest in a 30-year debt note. You can invest in a 6-month debt note. We typically like to do a shorter term debt time horizon just because we want to be able to have that liquidity should opportunities come up. And that's how we have our overall debt structured. And the debts that we would invest in is typically going to be somewhere on the short term horizon. We're looking at anywhere from 3 to 9 month time horizon. So again, so we can have that liquidity come back, opportunity comes up, we're there ready to invest in the next opportunity. So on the private lending side, let's talk a little bit more about, okay, what is private lending? And I think there's a little bit more on the next slide. Let me just switch over to the next slide. So what is private lending? Basically, it's lending to different types of commercial organizations, normally businesses. What we'd like to concentrate on is residential. There's no real detriment or benefit against either one of them, depending on where you sit on the capital stack. I would say there's a lot lower barrier of entry for a residential property just because the sheer amount that you would need to invest as far as capital would go into a commercial property versus a smaller residential property. We'd like to target somewhere between $300,000 to $600,000 debt loans. And the reason for that and targeting that amount, and obviously this would be market specific, but we want to make sure that if we are lending against a property and something happens, just say the borrower and has to run away and now we're left with the property. And that, again, let me take one step back because I didn't mention that. Normally on the debt side, if the borrower defaults, normally it depends on what state. You're gonna have to look at the laws. Every state is a little different. But normally you're gonna foreclose on a property and you're gonna take possession back of that property or try to liquidate that asset and get your capital back. that would not necessarily happen on the equity side. It'll be a little different because you at that point on the equity side would be the borrower, and the lender would have the legal opportunity to foreclose if it comes to that. So if it comes to that, we want to be into a position where we can say, okay, now I need to take possession of the property back. What can I do with the property? Obviously, and again, this is market specific. It would be looking at a market, like I can't compare Hawaii to Kansas City. It would be completely different. The amount of capital that we're looking at and the total cost of the asset will be completely different. Rents would be completely different. But looking specific at the market and the property type, we would then be able to say, okay, if I have to foreclose and take the property back, what are my exit strategies and what can I do with the property? Can I rent the property out? Do I have to turn around and sell the property? Can I short-term the property? So having it at a specific price point for a specific market gives you more options and allows you to, I guess, pivot if you need to pivot. The property, like I said, is definitely secured against, the money that we put in is secured physically against the property through different types of instruments. We use both trust deeds as well as mortgages, and these are different between the different states and a judicial and a non-judicial state. Now, if you were to, anyone can do this on their own, private lending. Well, I wouldn't say anyone. Let me take a step back. You'd have to go and look into your regulatory laws. There are laws that govern who can do what, if you need a license to do it, and it's different between different states. So I would say go look up the laws that apply to the states that you're investing in. But it's extremely important to vet out the properties and to vet out the market, to vet out the buyer, to vet out the properties, and make sure that you're securing, if you're going to put money into a property, you're securing that money against the property, against a promissory note, and probably against a personal guarantee. Making sure that the borrower has the ability to repay the loan. And then, like I said, making sure that the property that you're lending on has enough equity to cover you if something happens. So you want to make sure we would look at, like, even historical, just looking at overall historical downturns. If I'm in a market where back in 2008, 2009, I seen a 30% decline, I'm going to want a 30% cushion on the equity positioning that I have left over after my original capital has been put into the project. So, sorry, in my peripheral, I'm seeing comments come up. I apologize. If you guys do have a question, just come off mute and definitely ask your question. Our fund, and again, this is the one thing that we look at in our fund. So we do both debt and equity. And there's definitely pros and cons to each one of them. Today, we're talking more on the debt side to kind of illustrate there is a distinct difference between the two. Again, the biggest, just overall, you're going to have a higher return, or you're going to have a higher potential return on an equity deal, but you're taking on a bit more risk. So you're just looking at the risk profile. On a debt deal, you're definitely going to have a lower overall return. Still, if you're looking at private lending in the grand spectrum of things, it's still significantly higher than what you would get if you just left your 401k in your traditional 60-40 portfolio. And you're definitely taking on much lower risk. Again, there's always risk in every investment that you can possibly do, but you're just taking on a lower risk profile in the debt deals. And I just wanted to kind of, before we move on to the next slide, you're just looking. So one of the things, there was a few webinars ago, we talked about just overall risk profile. We talked about standard deviation. We talked about Sharpe ratio. I would say that's kind of an important metric to look at, especially if you invest in the equities market as well. So I try to diversify between that as well. Now, if you're looking at these things, you want to be able to understand, again, if I'm putting capital into something, I want to understand what is my risk versus reward, right? I mean, that would pretty much dictate how you would allocate capital. You can, if you have additional capital, you can probably get more risky with it, but you also want to make sure that you have capital that's still growing, that's in a safer, a much lower risk profile. Now, again, looking at your standard deviation, I'm just looking at standard deviations between different investments that you do. If you look at the equity market, you're going to have a very high standard deviation there. I mean, it's going to be somewhere in the low 9%, 10%. It depends on what sector of the equities market you're looking in as well. Now, if you're looking at some of the real estate, the alternative asset real estates, you're looking at, even on like a multifamily, it's like a 10 to 12% standard deviation, meaning that the returns can go really high, they can go really low. So you're looking at the cyclicality of that particular asset. Now, when I'm looking at debt, it's like half of what it is for most of the assets that we're looking at. So again, it tells you it doesn't fluctuate as much. Now, there still is fluctuation, especially when the Federal Reserve is raising rates the way they are, but it's just a much lower impact to the variation between, again, just between cycles. Now, again, looking at your Sharpe ratio, that's another one too, because you're taking into consideration, like, what is my risk-free rate of return? And just before I jumped on the meeting, I looked, I think it was at 4.12, and it's targeted off the 10-year treasury. So what is my return that I can get? What is my risk-free return? And I'm dividing that against the standard deviation. So the higher the Sharpe ratio, the better. So if I look at a typical 60-40 portfolio, you have a Sharpe ratio of about 0.46. So again, the higher the ratio, the better. Now, on your standard debt, we're looking at a Sharpe ratio of about 2.57, so significantly higher than what you would get even on a 60-40 portfolio, which is somewhat relatively balanced. It's a relatively balanced conservative portfolio where 60% is in equities, 40% are in bonds or mutual funds. So again, looking at it, you just got to ask yourself, is my portfolio diversified enough? I would never recommend someone to actually get out of the equities market. I think it's more beneficial that they diversify. I think there's a lot of opportunity on alternative assets, and I would say there's a lot of great alternative assets. Well, I would say look at the alternative assets and still make sure that you have some cushion on your debt side, depending on where you're looking at on overall balancing out your total portfolio. You want to?
Who wants to go first?
Let's let Zasha go first.
So with that, given our team experience, we have experience across the board as both lenders of residential and commercial properties. And so for me, for those who don't know me, I started off in the fix and flip space, and then I kind of transitioned into also lending on other people's projects. So I both raised private money and then lent on my own, and then now have experience doing that through the fund. And so I've seen the benefits across the board of just a more, I wouldn't say a more steady return and a little bit more predictable. And so that's why I chose to invest in that capacity.
I can jump in next. So like Chris and Zasha, we got started real estate investing by becoming private lenders. We had some cash from a house that we had sold in Texas. We had added a lot of value to it because we had done a full remodel. We're handy, and it was supposed to be like our forever home. So we just tore it apart and built it exactly how we wanted it. And then when my husband was laid off in 2017, we left Texas and moved to Utah kind of suddenly and sold that house. And what ended up happening was the amount of cash that we were able to pull out of that house. We didn't need that to put on our down payment on our next house. I said, well, it would be better if we took this money and invested it rather than throwing it all at the next house and having like super low monthly payment. Let's just do a regular monthly payment with your job, and then we'll take this and we'll invest it. But then I had this pile of cash and I was like, oh, I have no idea what I'm doing. I don't know what to do with this. And I was really afraid to mess it up. And so one thing that my husband said that really helped me, he's like, well, we made this money off of real estate because it was from a house sale, right? He says, so let's go invest it in real estate. And it's just like monopoly money. Like if you lose all of it, we're no worse off than we were before, because you can't eat the equity that's in your house. It doesn't do you really any good until you can convert it to something that's an asset that's paying you. So we went and we found a local house flipper. He was looking for some capital to be able to put into a particular project. So he put me as the first lien position, meaning like if he had done something he shouldn't have done, like I would have owned that house. And I want to give you a couple of questions that are important to be able to ask when you're getting into private lending, especially if you're doing it through a fund like ours, to make sure that you're getting into a good deal and a legitimate deal. So we know you have a lot of options out there and a lot of places that you could go. And so we just want to make sure that you protect yourself. And we believe that if you're diversifying in equity and debt, that you should be with different areas, different asset classes, all of that. And so there are certain questions you can ask to kind of protect yourself when you're getting into one of these. The first thing I asked when I was lending was I needed to see some paperwork. I didn't know what paperwork I wanted or what I needed to see, but I needed to see some paperwork. So he put me in touch with the title company, and that really gave me a lot of security, because I was talking to now a loan officer that had an actual office that I could go and sit in and visit and talk to the loan officer and talk to them about what kind of paperwork I needed. So I just didn't want to take the word of the guy that was borrowing my money, right? I wanted to have some other people in here. So make sure that things are going through a legitimate source. Any lender who is lending out against these homes should have some sort of a lien on the title, and you can look that up on a public title search and make sure that that those assets are being disclosed. One of the unique features about the way that we're doing it through our fund is that you don't just put the money in and then we make all the decisions about what you invest in. You actually can see each asset on our portal, and it has deal information on each one. And if you wanted to, you could go and do due diligence on each one that we already own and make sure that we actually own the property. We have a lien on that. And so those types of things, it's very difficult to track, especially houses or things where it's a high volume, to track where all of those assets are. And this is very common in things like ATM funds, where they say they have this many ATMs and convenience stores across the country, and you don't really have a good way to verify that, to make sure that it's a legitimate fund and that is being invested in what they say they're going to be invested in, all of this. So I feel like that the red flags for me was, or I guess the green flags in this case, were that we were going through a legitimate title company and that I could track the investment specifically. I knew the address, I could drive by, I could walk through it whenever I wanted to. I had a lien against that in case anything happened. I would have taken possession of the home. I don't know what I would have done with it back then, because I didn't really know how to fix a flip, but I knew a lot of people who did. And so I didn't really want the house, but it was comforting to know that it was collateralized by real property. So that was my first experience with that. And then we went on to become private borrowers ourselves when we purchased an apartment building, 2 apartment buildings in Little Rock, Arkansas. We bought them on seller financing, basically a rent to own note, like a master lease on 2 apartment buildings. And we brought in a couple of partners. It was a joint venture, so it wasn't like the limited partner situation. It was just a couple of people who had some cash to put in. But we didn't really have enough to cover all of our renovations. And so instead of syndicating it and bringing in limited partners, what we decided to do instead was to bring in private lenders. And Dawn in here was one of the private lenders on that project. And that's actually how we met and the first time we worked together. And we had probably 5 or 6 people come in and put capital into that project, where we renovated that building, fixed it up, and then a year or so later, we ended up selling it and then distributing the profits back to our lenders, and whatever was left over, we as equity partners were able to split. So we paid our lenders first, and then we got paid basically whatever was left over, we split among ourselves. And so we've done a lot of private lending, and we've done a lot of borrowing over the years, and I think it's a great way to be able to capitalize your projects and get great returns. There was no upside. Like, for example, Don got his return on that investment, but he didn't share in any of the upside. And so he was able to get really reliable payments. We were paying him monthly throughout the course of the project, and we didn't get paid until the end. And so that's kind of the pros and cons between debt and equity. But we felt like equity partners in the long run would get a bigger chunk. And so you really have to kind of look at the project and decide which way you're going to go. And then one of the other reasons that we're focusing on debt as well as equity in our fund is because, again, diversification. We want to make sure that you as an investor can look at your personal situation, your risk tolerance, your tax situation, and be able to make decisions based on what's best for you. And then we can bring you projects onto the portal that you can opt into one at a time, so that you can say, hey, I really need some more cash flow right now, so I'm going to choose something that has reliable cash flow, like private lending. Or you might choose something else to say, hey, I need a tax write-off this year because maybe you sold a property and you need to be able to offset those gains. And so it gives you a lot of control over what you're investing in. And that transparency is another one of those questions or red flags you should be looking out for. How transparent is the deal that you are investing in? Can you see the property? Can you see the paperwork? Can you choose between them and get details on it? And so we always want to make sure that that transparency is not just for you to have more control over what you're investing in, but also to have peace of mind that this is a good investment, that you can trust, what we're doing. So that's been our experience with the private lending, and as borrowers and as lenders. So holler with any questions. But and then Chris, he's the master of the hard money. definitely has a lot of experience issuing loans. So I'm gonna turn it over to you, Chris.
Well, I wouldn't say expert. I can be completely honest. I didn't know what the heck I think I'm like most people when they first get into real estate, and we've been doing this for 2 years now. My wife and I didn't know what the heck we wanted to do. She thought we watched way too much HGTV, and my wife was going to be Joanna Gaines, and I was somehow going to be Chip Gaines, and it lasted half of a flip, and they were like, "Nope, we're not doing this anymore." With real estate, one of the good benefits I think of just real estate investing is just like the network of people that you get to meet and the relationships that you build along the way. We got to meet a lot of great people that showed us, like, we were, I guess we were fortunate enough to see the ins and outs, and probably the fortitude to know, yes, go talk to an attorney, make sure you get all of your title documents. And even that too, there's a lot of documents. Not all attorneys are created equal. You would want to do your homework and make sure that the documents that you have in place, if for some reason you wanted to do this on your own, the documents that you have in place is going to cover you. You want to look at insurance is huge, right? Like, where do you live? What kind of insurance do I need? Do I need flood insurance? Do I need earthquake insurance? Is my property in a flood zone? Am I truly covered? And yet you have to understand all of those components of just looking at it and make sure that the documents that you have applies. Like Emma brought up a really good point, like just understanding how the process works. So we were fortunate enough to meet individuals that helped us along, and we're open to show everything. Yes, this is the attorney that I use. You probably should go talk to him. Obviously, we talked to maybe 3 or 4 attorneys before we got all of our documents squared away. And then we ended up falling into, again, we didn't really like the fix and flip life. It took us like half of a flip. We bought a few houses too, and we didn't really like that either. So we ended up falling into lending, and we've done quite a bit of deals. I think just in the last 2 years, we bought and sold 40 or 50 houses. It was upwards in the $30 to $40 million range. And we continue to do that today. We still loan. I get a few deals every single week we're loaning on. And that's why we wanted to bring these opportunities into the group, because we've done so much of it as a group. It's like we're pretty proficient at it. We have all of our processes in place, our legal documents. We underwrite very, very conservative. I will look at, like, even looking at historical, I'll have every single zip code in the entire United States, and I'll know what happened with that zip code at a specific time, predicated off of where interest rates were at the exact same time. So I can predict I can't predict where interest rates are going to go. No one can. You would have to be in the back pocket of Jerome Powell. But I can kind of sort of understand, okay, they're talking about raising rates again. I can safely say it's definitely not going to drop. I know interest rates came up, so I can predict exactly what's going to happen with the value of the property, and I can apply that to the future value. So it's like understanding, right? What is the value of the property that I'm lending on? Do I have enough equity in the property that I'm secured should something go wrong? There's definitely a lot to it. And get yourself educated. Make sure you have all the right documents, and make sure you're going to do thorough due diligence and vetting of the property.
So step by step, how to invest with us. go and visit our website, risecapitalist.co, create a login to view our opportunities, and then you can set up a welcome call with one of our team members. And we need to verify if you're accredited or not. Now, this fund right now is for only accredited investors, which means typically you'll have a net worth of $1 million or make 200,000 on your own or 300 together with a spouse. There are some other stipulations, but you would have to talk to your CPA to verify that. And then you can use our free educational resources. We also have meetings on Monday nights open to a free club that you're also invited to. And then you would go on the portal and browse the investment opportunities, evaluate and see which ones that you want to participate in. And you can review the offering. There's pitch decks, pictures, all the numbers in there as well. And then from there, you would go and fund the deal, sign all the documents on the portal. So next step would be to monitor your account, review the monthly newsletters, quarterly reports that come in, attend the online call. They will also be having meetings. I'm not sure when those will be for each of those specific projects. So just be on the lookout for that and attend and ask any questions you may have. And then from there, you kind of, don't do any of the legwork. That's what the operators do. And then you receive scheduled distributions. And if you have any questions, you can always schedule a call with our team to get updates.
So I did see a question come through. Thanks, Zasha. I'll pick one. I'm not 100% sure. Let me see. I know it had something to do with hard money and SEC. It went through real quick. I didn't get the chance to see the exact question. I said, how does SEC regulations affect hard money lending funds with the new regulations coming into play next year? Does anyone know the answer to that? I'm not even, there's a lot of new regulations coming in to fruition. Most of it is it has to do with reporting requirements. I don't know all of the regulations because they haven't finalized anything. As regulations are coming to fruition, we're definitely on the forefront of watching out for what those regulations are. To my knowledge, it shouldn't impact anything on the lending side specifically. Besides, again, the more requirements, they're looking at more requirements for accredited investors. There's a bunch of things on the plate right now that they're looking at. Maybe if you could be more specific with the question, we might be able to, unless anyone else knows the answer.
I don't know the answer. The 30, I think it's like 30 new rules that are being proposed for 2024. Most of them have nothing to do with the actual lending. It's more like disclosures and reporting and investor reporting. But there are a few that have to do with something else. I'm not seeing anything that I've been like, oh, well, this is going to shut down, like lending or as we know it. It's more about empowering the investors to be able to get more information, to put forth proposals, things like that. And then there might be some specific ones that are on other stuff. So let me see what's it there. Accredited investor limits to qualify or stay qualified once in a lending process. I think that they're going to be changing the accredited investor definition sooner than later. There are a couple of House bills in right now that have various types of changes to that. If I had to guess, because what we're doing right now is just guessing. I believe that the $5 to maybe $10 million of net worth, and that there will be some sort of a free exam that they're proposing to offer. And until you have basically investors and then investors. I don't know if we'll still be able to invest in any of this kind of stuff. I think that exam is really going to be a big thing where if you're not accredited, you got to take the exam. But I think that's coming up. But she says I'm cutting out, so I will. Am I cutting out for everybody?
Yeah, you are, but we got most of it. It's speculation.
No.
It was in and out, but the synopsis was you're speculating what's going to happen. They're going to up the requirements for being qualified as an accredited investor, but they're going to allow certain exam outside of like your series 7 and your series 65 exams that would typically qualify you today. Was there? What I hope that answered the question. Again, there's none of it's finalized yet, and the things that are finalized again are more reporting requirements that yes, it's more of the behind the scenes wouldn't impact. I mean, it's going to cost us a little bit more because we have to do more due diligence. But I think honestly, I think it's a good thing. There's just to there's so much fraud out there, especially with the opening of a lot of these new funds. I think it's better to have more disclosures and to really let the investor know exactly what they're investing in, to give them the opportunity to make the right decisions. So, I mean, that's the overall goal of it. Now, I mean, if it what actually happens, again, that's kind of left to be seen.
Yeah, it has a lot about deceptive practices and kind of limiting what we as fund managers can do, that kind of stuff. And I think it's the SEC is there to protect investors, but I don't think it's going to change the fundamentals of what of the lending industry. It's more just setting a higher bar. All right, great question, because there's a lot going on, and a lot changing, and I think it's changing for the better. I'm actually really looking forward to these new changes, because I feel like what they did in 2013 and then again in 2021 really opened up these kinds of investments for like regular people like us, because before that you didn't know anything about them. The wealth thresholds were just kind of rich get richer, and what was intended to protect investors really was just limiting a lot of people from being able to invest in anything other than the stock market. So I'm actually excited to see the new regulations come out, because I think that they're aware of opening these things up more and putting in more of the onus on us to disclose and all of that. And in so doing, holding us to a higher bar, more investors will be allowed to hear about this stuff and participate.
Yep, exactly.
Okay, so Kay says, is your private lending fund structured as an LPGP with a waterfall? No, the private debt is that's your return. It's a stated return for the deal that you invest in. They may be a little bit different. So you'll just have to review each deal individually. Some of them will be, it's usually like a 10%. It really just depends on how much they're borrowing, how fast they need it, that kind of stuff. So yeah, but that stated return on the debt deals will just be the stated return. There will be an LPGP waterfall on the equity deals that we will be adding on occasionally. So most of what you're going to be seeing in the portal will be debt, but it'll kind of come in clusters. You might have a big cluster of debt and then another cluster of equity, but those will be definitely on a split waterfall. And the advantage of doing the equity through the club is or through the fund, is the same as at the club, is where we're able to pool our capital and then use that to hit those incentives where we can get higher returns. And the more capital we're able to pool, the better deal we're able to negotiate. So our goal is to bring you a better deal investing through the fund than you would get by direct investing with a sponsor.
Very good. Very good catching these questions too. I'm not seeing them pop up as quick as you are. Is there any other questions out there besides Zasha being beautiful and gorgeous? Any other questions? Are there restrictions on taking money out? No, you can take money. Well, if it's in an active deal, yes. There's a restriction on taking the capital out. If it's not in an active deal, then no, there's no restrictions on taking capital out. There's minimums. I don't remember what it is off the top of my head, but there are minimums on how much you can take out. So you can't like go in there and take out $10. But you can go in and liquidate your capital if you needed to, or you could leave it in and have it compound.
Yeah. So once a deal matures and that capital comes back into your pocket, basically you can withdraw it through the portal. You could choose to invest it in another deal or withdraw some of it. If there are certain circumstances that can get fund approval, if you do need to withdraw funds, that we can recapitalize those, but those would be pretty extenuating circumstances. And that's a good question, because while the money is in the deal, and we talked about this a couple slides ago, it's illiquid while it's in the deal. And so that's why it's nice to have the cash flow coming off, because you are getting your money back on pretty reliable regular payments. One thing about equity deals is, even though they can cash flow, and they often do, it's just more unreliable because it's profit sharing, not a stated return. So that's why we like these debt deals. And that's why you just need to plan on leaving your cash in during that time, unless, if you have something happen, we're here, communicate with us, and we will work something out. But for the most part, like, plan on it being illiquid during the term of the loan, including the extensions. So we like to just make you aware when you're reviewing it, if you need it back in 9 months, but there's a 3-month extension possible, you might want to rethink that. So just make sure your timelines are, do you understand your own timelines as opposed to what's going on in the loan timeline?
Very good. Was there any other questions? Did I miss one? Are we then self-servicing the loans? You want to maybe ask that a little bit more specific on that question?
We're
There's
not
not-
using a third-party loan servicer, if that's what
Yeah.
you're referring to.
There's not much to service on a typical short-term loan like this. So maybe more specific questions. Like we're going to get, obviously we're going to make sure we have insurance. And tax is normally going to be paid. So it's not like we have to make the tax payments, because the loans that we're going to normally look at is typically less than the time horizon for your tax payments. So we're not as concerned about that. We're just more concerned with, again, the bigger concern is we have enough equity to cover the capital that was injected into the asset. So there's not much there because it's such a short-term loan.
Is there a certain amount of time in months to get back your funds to move into another investment? Every investment is going to be a little bit different. So it's going to be the timeline of the investment. So on a single family debt deal, you're looking at 3, 6, 9, maybe 12 months. And on a larger commercial deal, where especially we're coming in like with mezzanine debt, that's going to probably be in there the life of until at least the deal is refinanced. So that could be longer, but each deal will have a projected timeline that is going to have, and you'll just review those individually. After 24 months, if you do need a return of capital, you can withdraw that. And then if something's still in an active deal, again, just talk to us and let us know, and we'll see. We'll see if we can release it from an active deal. Although that, like I said, would be extenuating circumstances. The difference between this and, say, like a blind fund, where you are putting your capital in and you don't know exactly how it's being used. They're going to send you reports and things like that, but you don't get to make the decisions. The fund managers decide what it's going to be invested in, and then they inform you of that. The difference between this and that is that in a blind fund, after a certain period of time, you can request it to come back, and then when they can recapitalize that, deals are kind of churning, they can pull that out. And so it's a little bit of a different process. This is more of a deal by deal basis than a blind fund would be, where it's just, hey, at this timeline, you can pull out all of it if you want to. So you're just going to be doing it deal by deal, which gives you a lot more control. But there are definitely pros and cons to both ways of doing it.
Kimo asked the question, do you have sufficient deal flow that there will always be an opportunity to keep my funds invested? So if we're looking at, and it depends, I'll be honest, it depends. If you're looking at strictly equity, probably not. I mean, our target goal on the equity side is 4, maybe 6 deals a year. And we actually look at, in fact, I think we have like 3 or 4 large equity deals in the queue right now that we're looking through to see if it's something we want to engage in. Be honest, lately a lot of the deals just weren't penciling out. I think you're going to talk to a lot of sponsors and you're going to hear the exact same thing. The deals just don't pencil out. But we do have a ton of deal flow coming in. They're not really making sense for us to pull the trigger and bring those deals into our funds. Because again, our goal is to make sure that we're looking at the entire landscape and all of the different asset types, and we're bringing the right deal and opportunity to whoever we have in our fund. On the debt side, I would say there's enough deal flow that if you did exit out of it and your money's sitting on the side, it'd be sitting on the side for maybe 1 to 3 weeks at the most. And then another equity debt opportunity would come. Obviously you're going to enter and exit at different times. I do turn down quite a bit of debt deals as well. And then sometimes debt deals, we had a debt deal that we locked in. I'll be honest, it was just 2 days ago. The borrower backed out because there was an issue with the property, or I think they got another lender in there. So I mean, it happens. So things do ebb and flow. It's very, very short term, the amount of time with these. So if you guys actually wanted to do deals on your own, I mean, that's one of the other things that you have to compete with, is getting enough deal flow and timing the deal flow with the capital that you have to deploy. And just kind of balancing all of that out. Sometimes you're going to have capital, sometimes you're not going to have deals, and then they're going to work vice versa. But we have enough deal flows that if your capital is sitting on the side, it'd be 1 to 3 weeks at the most.
I think one of the most annoying things about short term, where they're turning around really quickly, is where you have to think, okay, well, it just came back now. What do I do with it? Right. And so if you're looking to have it really always deployed and never waiting to go into a loan, that would be probably a good fit for some of the longer term stuff, like maybe 12 to 24 months instead of like 3 to 9, because as you're building a relationship of trust with us, some of the short-term ones will make more sense to see, like, are they doing what they say they're going to do? And are they easy to work with? Do they communicate well? Kind of testing it out. But if it's something where, I want to kind of set it and forget it, that's why we'll be introducing a longer-term commercial loans, as well as equity opportunities that will be a couple of years instead of a couple of months. Again, it's about diversifying and giving you options to pick what works best for you.
Do we have any other questions? Is there a certain amount of time? Did we answer this? Oh, wait. You probably covered this, but what are the average returns? If we're talking strictly debt, it's a fixed return, and they're typically going to be around 10%. The equity deals, they're all different depending on the types of asset that we're looking at. We do have targets, though. Our target, and depends on what you're looking at. Again, this webinar is typically talking about cash. So if you're looking at strictly cash flow, again, they're all different. We do development deals as well. We're in a few development deals. You're not gonna get any cash flow. You get your money when you exit out of the property. As far as like an overall return, if hypothetically, it goes back to Kimo's question. If it was timed exactly correctly, and you entered one debt deal, exited the debt deal, and entered another debt deal on the exact same like continuous flow, and you didn't have one day where your money was sitting out, you'd earn roughly about 11, almost 12% IRR. If you're looking at like multifamily, our target is roughly about a 17% IRR. Storage is going to be about 20, 21. Development, we're in the mid 20s, mid to high 20s. Industrial, we're low to mid 20s. Those are our typical target returns. Now, again, you guys got to understand too, you're going to take on more risk as well, right? You just take that into consideration while you're looking at it.
Fund level return. We have fund level returns that will be disclosed in our reporting. If you invest in every deal that the fund put out, you could kind of be close to that. But because you can pick and choose, your returns will vary widely from what the fund as a whole is doing. And that's another difference between this and the traditional blind fund. The blind fund's doing, you get that. This, you have a lot more control over what you invest in. And so your returns will vary. Like if you only are going after high yield equity deals because you want the tax benefits or you're chasing yield, your returns will be very different than if you're going for the reliable cash flow types of returns. And it's really up to you what kind of returns that you want to see. But we do have target returns on each investment that you'll be able to see with each deal that we bring out. So the process is pretty simple. You go to risecapitalinvestments, you hit invest with us, and that will take you over to our deal portal where you'll create a login. And when you log in, you'll be able to see opportunities. So the opportunities are for accredited investors only, and you will upload your documentation straight to the portal to verify that you're accredited. And once that happens, you fund. And once you have funded, you can start allocating your funds across a couple of different deals. And then you can get started. If there's only one, or if there are two or something like that, you can kind of allocate it out as the deals come through.
Are all your deals in one fund and expanding? Yes, it's the way our fund is structured is the evergreen fund. So deals would come in, go out. Again, as Emma said, I think she's mentioned it a few times now, you actually get to choose which deal you put your capital into. So it's not like a lot of blind funds where you put your capital into a fund and then now obviously you can just say, yeah, just run with it invest in whatever deal we have the opportunity to invest in. And that goes back to what Emma was saying earlier. Then you would hit our overall targeted fund returns. But again, because the way that the fund is, the legal structure of the fund, it allows you to be able to invest in whatever deals you literally want to invest in. If you want to just do debt deals, then you're only in debt deals. If you want to do one debt deal and two equity deals, then that's exactly how you do it. And you have a bit more control of the opportunities that you put your capital in. And again, it's our goal is to go back to Kimo's comment, is to keep bringing consistent deal flow and opportunity to our investors to be able to invest in.
You also have a lot of control over the deals that you're going to see in the portal by communicating with us, the types of things that you like. Obviously, we're going to know what you like because that's what's going to be funding, but just reach out. I had somebody ask if we were doing any short-term rentals because that was what his accountant recommended he do to offset his W-2 income, the taxes. And yes, we do have one short-term rental deal in there right now. It's a luxury new build. And so if it's something like, hey, my accountant said I need to do this, or I heard this is the next hot thing. If enough of you are coming to us and communicating with us, then we go out and we curate the best deals in that quadrant. And so it's really easy for you to choose not just from the deals on the portal, but to influence what deals we're even looking at. We want to bring you stuff that you want to invest in. So just let us know.
Absolutely. Okay, we're at the top of the hour. You are very welcome, Kay. And thank you for all the questions. That was really good. We got to go make sure we study and answer your SEC questions. Make sure there's nothing weird. To my knowledge, there isn't. We literally just had a meeting. Maybe I think it was this week or the beginning part of this week or latter part of last week, where we're going over the impacts of the SEC and what their proposals are. So, but thank you very much. Thanks everybody for coming. Thanks for your questions.